Good morning, good afternoon, good evening, my viewers, and welcome to my channel, YouTube channel, Money Talk with Dr. Tony Babuchi. Please subscribe to my channel by pressing the red button or the bell. That way, anytime I have uploaded any new video, you should be able to see them. You can also subscribe to my YouTube channel. My Twitter handle, you can follow me on my Twitter handle at ebabuchi.doctor, so that anytime I have any update on my Twitter, you'll be able to also see those updates. In my last video, or in my maiden edition of the video, I told you I'll be starting off by discussing on centralized finance, decentralized finance. Because decentralized finance now is the in thing in the field of finance. But before I do that, before I really go into decentralized finance, I also need to build a background on what is centralized finance. Okay, because that's the only way you'll be able to understand what is decentralized finance. If you understand decentralized finance very well, when we go into the deeper aspect of decentralized finance, you'll be able to draw the contrast. Like I said in my first edition, I'm going to make this discussion very, very simple. I'm going to make, my aim here in this channel is to make finance very interesting, devoid of all those financial jargons, all those technical jargon, and even where I use technological inputs. I'm also going to make sure that I don't use all those technological terms, so that everybody will be on the same page. Like I said earlier, this channel is not just for people, professional finance people. It's for everybody, in as much as you touch money, in as much as you deal with money. This is the place where you come and you get resources, you get materials, you get tidbits on personal financial management. You also get tidbits on other areas of traditional finance, and also you get new development, new technological development as they impact finance. So here we are going to bring you beautiful analysis as it affects business, but albeit in a very simplified manner, so that you'll be able to understand it. So like I said, I'm going to start off by running some series of videos on decentralized finance, the application of decentralized finance, and what decentralized finance can do in the field, can help us do in the field of finance. But before I go really deep into decentralized finance, I also want to explain to us, build a background on what is centralized finance. It's only when you really understand centralized finance that you'll be able to understand what decentralized finance is and how it impacts on the economy, on how it can make finance even better. So today I'm going to start on decentralized finance. But before I do that, like I said, I'll go into centralized finance. Now, what is centralized finance? Centralized finance is the finance that we practice as we speak, the practice that we practice in Nigeria, where you have the commercial banks, the investment banks, the insurance people, the stockbrokers, all of them playing in financial intermediation. So centralized finance is a situation where you have financial intermediaries, okay, playing between the buyers and seller to bring them together to come to an understanding. Now, in traditional finance, okay, the traditional finance or banking, as you may see it, is just the transfer of values from the surplus unit to the deficit unit. The surplus unit could be those people who have deposit and wants to give to the bank. They could also be, that is in commercial banks. They could also be those people who have shares and they want to sell in stockbrokers. They could also be those people who have money and they want to invest in bonds, in other fixed income instrument. And when I mean fixed income instrument, I mean things like bond, I mean things like debt, a lot of them. Okay, so those are the surplus units. You also have the deficit unit. Those are the people in commercial banks that come to borrow, the businessmen that come to the bank to borrow money, to do business. They are the people who have money and want to buy stock in the stock exchange. They want to buy shares. They want to buy treasury bills and other corporate stocks, corporate bonds, that is for fixed income securities. They want to buy corporate bonds. So you see, but in between these two people, you have financial intermediary. If it is a bank, a customer has fixed deposit, he has current savings account, and he's not doing anything with it. The bank takes those deposits and they give the customer an interest. Now you have the deficit unit, the businessmen. okay, the small scale entrepreneurs, the multilaterals who want those monies to use them to expand their business. So they come to the bank and they say, hey, we need money, we need a loan. So what the bank simply does is they will take, what the banks simply do is that they will take that money, okay, that was given to them as deposits, and they will lend it to the deficit unit at a fee. So if, for example, they are giving the fixed deposit people maybe 5% okay, per annum. Oh, okay, let's just say 5% per annum for the purpose of argument. Also, I know that at a point in time, rates came very, very low, but now, because of the increase at the Monetary Policy Committee, rates charged by banks now are coming up. As a matter of fact, money banks now are increasing their pool rate. So, assuming, okay, for the purpose of argument, we say the lending rate is the deposit taking rate is like 5%. Now a customer comes and a borrower comes and say, I want to take money. So what the bank will simply do is to lend that money which they took from the surplus unit to the deficit unit. They will lend it to the businessmen and they will put a markup. Maybe if they took 5%, if they are paying 5% for those interests, what they will just simply do is to maybe add a markup, maybe 3%, maybe 4%, and it comes to like 7% or 8% or 9%, and they will lend. So that for doing that financial intermediation, taking from the surplus unit and giving to the deficit unit, they are charging a fee, and that fee is an interest which they charge to the borrowers. Okay, that's what financial intermediation is. They charge that fee just simply because they are bringing two people who one is selling and one is buying, and they are bring them together in the financial marketplace. The same thing with somebody who has a stock. For example, you have a stock with your stockbroker and you say, I want to sell this stock. You give them instruction to sell. Their job is to find people in the market who also want that exact stock. Okay, and when they sell to them, they charge their commission. Sometimes it could be 0.25, it could be as high as 1%, it could be as high as 1.5, depending on the bargain between you and the stockbroking firm when you were opening, the relationship with them. So in every centralized finance, there's always a financial intermediator who also charges a fee. Okay, so what happens is that when they charge that fee, they are compensated for their job. Now, in centralized finance also, you have the central bank also that regulates the activities of all these commercial banks. Whereas in the investment banking space, you have the Nigerian Security and Exchange Commission that also regulates the activities of the various financial intermediators in this capital market. They could be stockbrokers, they could be investment advisors, they could be portfolio managers, they could be underwriters, they could be issuing houses, different players in the capital market. All these people are also regulated by the Security and Exchange Commission. These are also players. You come to the insurance area, you have the insurance firms that intermediates between the people who are taking insurance and the people who are also giving them deposit. So financial intermediation is the key thing in a centralized finance, and we are going to, as we discuss this topic, as we move, you see how the activities of the financial intermediators are really weakening the CFI, the centralized finance, which is what we are going to see as one of the drawbacks of centralized finance. So I needed to just make this clarification and make this background so that you can really understand. Now I want to show you something. I want to quickly show you something. Now, for example, I'm saying here, sorry, let me, okay, great. Now, oh wow, okay. Now I was trying to give you something, but let me also say that centralized finance has also come a long way. You remember in those very old days when people go to the bank and they go and stay almost the whole day. In those days when our uncles were into the banking industry, you see them, they would come back home maybe around 10 o'clock, around 9. You ask them, what is the problem? They say, oh, we had to balance. We were looking for 1 naira and we had to look for it until we finally balance. Sometimes They don't even balance that same day. They come the next day. And until they balance, they can't open the books for the other day. So you see a lot of customers coming in, and they are waiting because they have not balanced their books for the previous day. Now from there, we migrated to automation, where the banks started using, banking applications. I remember in those days, you used to use banking applications like Capiti, like Microbanker. All those computer applications were based on commands. It's not the normal click and paste. It's not the Windows environment. Okay, it's just where you give commands. And so banking has metamorphosed over the years based on technology. Now, technology has been very impactful on banking, on finance, be it commercial banking, be it investment banking, be it insurance, be it pension managers. They rely on technology to improve their processes. So over the years, finance has metamorphosed on the backbone of technology. So that is established. And then after the first age of automation, you now moved, into the areas where we started having internet banking. You started having ATMs. People can stay at the comfort of their homes. You no more go to the banking hall to carry your phone, to take tally and wait for more than 3 hours just to withdraw 5,000 naira, just to withdraw 10,000 naira. Some people stay even over 6 hours in those early days. I mean, as early as 1980, 1985, those were the years when banking was very dull, very slow, because the technological penetration into the banking and financial industry was very, very, very low. So over the years, this kept coming, this kept increasing, and things kept getting better. In the centralized finance, to the point where you can stay at the comfort of your home with your phone, and you make a transfer and it goes from your bank, and the next 5 minutes you're calling somebody and say, have you gotten a alert? And the person, oh yes, I gotten a alert. And banking became very easy, and people thought oh, we have arrived. People thought oh, this is the best that can happen to us. Your checkbook is finished, don't need to go to the bank. You just stay on with your phone, and you order a new checkbook, and the bank calls you and said it's ready, and you go there, you sign it off, and you go your way. Banking has metamorphosed. Very interesting, to the extent that we came to the point of Industry 4.0, where you don't even need to ask a bank for money. They just profile your credit rating based on your transactions and everything, and they just call you and say, hey, you know what, we can give you, based on your salary, blah blah blah, on your spending pattern, we can give you so XYZ amount of money. And you're like, wow, how did they even know about me? Those are the era of big data. They are using your spending patterns, all the financial behavioral patterns to analyze, using various complex algorithms to analyze what you need, how you spend money, what are your needs. Beautiful. And we thought that banking has evolved, and we thought that, oh, this is the best that can happen to bank. But I tell you something, all of these technological developments still ride on the backbone of centralized finance. And somebody might ask, what is the problem of even it riding on the backbone? If these technologies can help the centralized financial institutions deliver such a beautiful services, as far as deliver such beautiful services to the extent that you can stay in your house and you do transactions without going to the bank. So why would anybody say that this is not beautiful? But you see, by the time you understand how decentralized finance works, you will see that there are a lot of drawbacks. No matter how beautiful, no matter how technologically advanced this centralized finance is, no matter how technological advanced the traditional financial system has been going over the years, it still has drawbacks. And in the course of this our discussion, maybe by next week, I'm going to do another video where I am actually going to compare and contrast the centralized finance and decentralized finance, so that you begin to see the difference and see why, despite all this technological improvement in centralized finance, it still has drawbacks. And let me briefly say it here so that I don't increase your curiosity, because I know a lot of people will be thinking, what are those drawbacks? Say them now. Good. One of the drawbacks is cost. Now, who are those people increasing the cost? The financial intermediators. As you're transferring money from A to B, you're paying cost. Who takes it? Is the financial intermediators. Who are those financial intermediators? The commercial banks, the NIPs, the switch companies. Those are the people that take those money. Because for you to move money from A to B, your bank A cannot transfer directly to account in bank B because there is no interoperability. I've used another word, market interoperability. That is another drawback of centralized finance. The banks cannot talk to each other. There's no interoperational relationship between one bank and the other. For one bank to be able to transfer money to another, there must be a switching company in the middle. A switching company must be in the middle to effect these transactions. Another drawbacks which I want to point out in centralized finance, so that you can begin to see why we have to move to decentralized finance when I discuss it. Another drawback of centralized finance, no matter how beautiful, no matter how automated you think centralized finance is becoming, it still has the drawback of delay. Now, you want to transfer money from point A to point B, for account A to account B, even in your same account in different banks, it still take a minimum of, if it's an instant transfer, sometimes if the network is good, it might take like 20 minutes or 30 minutes. Sometimes if the network is not good, you might get that value the next day. That is if you're transferring from your account in one bank to your account in another bank. But if you're transferring from your account in one bank to another person's account in another bank, God knows how long it might take. Yes, they will tell us it's immediate, it's instant. But we also know we have instances where you transfer money and because of network issue, the other person, the recipient of that money, does not get it till the next day. And this was supposed to be an instant transaction. So these are some of the drawbacks of centralized finance that I'm also going to discuss. And another major drawback of centralized finance, which I'll also help and increase more, is that there is no transparency. For example, if you transfer your money from one account in bank A to another person's account in bank B, if it does not go and there is an issue, what they just come back to tell you is that there is a network failure. What happened in between? What happened between bank A, between the switching company, and then bank B, you don't know. There is no way you can inquire. Sometimes even the staff of the banks don't even understand it. They don't even know it. What they just tell you is that the transaction failed and we're trying to reconcile. And of course, that reconciliation can take up to 1 week, 2 weeks, 3 weeks, even a month at times. And if it is an ATM withdrawal, forget it. You can really take up to 1 month. The minimum it can take for an ATM transaction between two banks to be reconciled is about 2 weeks. Now, why do we have to waste all this time despite all the technological improvement? So that is where decentralized finance comes in. And what is decentralized finance? Decentralized finance is a financial situation that allows for peer-to-peer transaction without any financial intermediary. Okay? It allows peer-to-peer transaction without any financial intermediary. In a decentralized finance, you don't need any financial intermediary. And that is why when researchers started looking at the drawbacks, a lot of drawbacks which I've mentioned of decentralized finance, they said, no, we can't continue like this. And then the emergence of the blockchain technology also increased people's curiosity, and they began to research further. How can this blockchain technology be applied in financial transaction, be it payment system, be it deposit, be it lending, be it collateralization, security arrangement, be it stock broking, be it the stock exchange, the exchanges, any of these traditional centralized financial services can also be operated in a decentralized, democratized manner using blockchain. And that is actually what decentralized finance means. Decentralized finance just simply means, a financial relationship where people can interact peer-to-peer directly without any financial intermediary, based without trust, without even seeing that person. And somebody is saying, why do you think that this one is even better than the centralized finance, where you have financial intermediaries like the central banks, like the commercial banks, like the investment banks, that will protect, I use that word in quotes, that will protect their customers. So somebody will just make that argument and say, oh, if this one is peer-to-peer, I don't even know this person. But what makes you think that I should trust him to the extent that I should be able to move my value from my position to him? What if he fails? What if he doesn't have that value? Okay, so these are some of the interesting things we are going to see, and we are going to also explain to you why it is better, safer, cheaper, and quicker to also transact using decentralized financial platform. So like I said earlier, decentralized finance is nothing but a computer protocol, a computer protocol that allows, okay, two people to transact peer-to-peer without a centralized, without an intermediary. Okay, now I won't, like I said earlier in my first video, I won't be using technical terms. I will try as much as possible to, you know, explain decentralized finance and the blockchain application in decentralized finance in such a way that anybody will understand it. Okay, now simply put, what is blockchain? Now, in my next video, I will go into the real development of blockchain, how it was developed over the years, you know. But today, I'm just building a background so that people can really understand what this is all about, what the analysis is all about, what the discussion is all about. So that when I go into deeper explanation of decentralized finance and the application of blockchain and blockchain operation and the infrastructure of the blockchain, you'll be able to understand what we are driving at. Okay. Now, the blockchain is simply a computer protocol, an algorithm that enables one to come to the platform, you know, to transact with the other person without even seeing them. Call it an efficient barter system. Okay, you can even call it an efficient barter system. We all know what barter system is. It allows for peer-to-peer transaction without any financial intermediary. Decentralized application allows peers to interact directly and remove the need for a central clearing house for interaction. Okay, it is a competitive marketplace of a financial application that functions at various financial primitives such as the exchange, lending, tokenization, and so forth. Now, what I'm trying to say here is that decentralized finance, okay, allows people to transact without even seeing the other, without even knowing who that person is. But you know that that person is there, and you know he has that value. You don't need a middleman. You don't need the additional cost of paying a middleman. Okay, so we are going to see how this is possible using the blockchain technology. Okay, but one thing you will know is that at the end you will see that decentralized finance is faster, is cheaper, is more transparent, and it's also safer. Though some people might argue that question about that fourth point, how safe is decentralized finance. Okay, but let me just put it this way: that's decentralized finance run on the blockchain technology. Now, and the platform that actually has the capacity to warehouse and be able to operate decentralized finance is the Ethereum. And why? Somebody will ask me, why the Ethereum? Because it is only the Ethereum that has the ability to warehouse and support a smart contract. Okay, because all this financial relationship will be encoded in the smart contract, so that when you perform a transaction on the blockchain platform or Ethereum platform, you don't need anybody to intervene. The protocol is already in the platform, so immediately you run that protocol, it runs automatically without any human intervention, because they are based on complex computer algorithm. Let me also state here that you don't need to have any idea of computer programming. You don't need to be a computer expert. You don't need to study computer science to understand blockchain application. In this channel, I'm going to make blockchain very easy to understand. I'm going to make sure that you don't need so much English or so much technicality to understand it. But let me lay the basic building block of blockchain technology. Now, just view blockchain as a system or computer programming that badges transactions into blocks. Okay, They batch transaction into blocks, into layers. You bring a transaction, you put it on top, you bring another one, you put it on top, you bring another one, you put it on top, and you link them using the hashing algorithm. And somebody will say, what is a hashing algorithm? A hashing algorithm is a protocol that allows you to generate numbers, strings of numbers, okay, that you use to link the last block, okay, the last transaction in a block to the first transaction of the next block. Does it sound difficult? Now, if you bring a transaction and you pile them up, okay, into blocks, and you batch them, and that process is called mining. I'll come to that in my next video. I will explain what mining is and how you can mine a transaction, and then how you can hash those transactions to the next block to link them, so much so that if anybody goes to change any transaction in the former block, the hash will change. The string, 64-bit string of numbers that you generated, which you use to link one block to the other, will change. That anybody who sees it will know that somebody has tampered with the first block, which linked to the second block. And now, even if you have 100 blocks of transactions, all of them are linked to to one another by algorithms, by electronic signatures. Call them a connecting rod if you want to. Okay, bring it down. Call them a connecting rod. It's a rod that links one block to the other. It changes one block to the other. That is why it's called blockchain. The transactions are batched into blocks. The blocks are chained to the next block using a hashing algorithm, which generates very specific and unique numbers based on the transactions you have in those blocks. So much so that if you go to any previous block and change any particular transaction, the hash will change. That anybody who comes into that platform, looks at the hash, will discover that this hash has changed. And then it's so transparent that you can go back and trace and see where the alteration was made, and you can remove it and copy the original block from the nodes, because a blockchain is like nodes. You have all the users as their nodes, and each of these users can come into the system to see what is happening. There's transparency. There's nothing hidden about it. You come into the system, you see everybody's position, and you can see what is happening. You don't need any special privilege to come into a blockchain to see what is happening. So there's transparency. Okay, so that is what happens in a blockchain. And when the decentralized finance app sits on the blockchain application, mostly the Ethereum, then it becomes very easy to write a smart contract inside the Ethereum that will control the financial transaction that exists in that centralized application. Okay, so it becomes very easy, very transparent to use. So the decentralized financial apps is a democratized marketplace. It is democratized because there is no financial intermediary, there is no central bank, there is no commercial bank, there is no stockbroker. You just come to the market and you meet the buyer and the seller. So that is why I said initially that it is an efficient barter system. Remember, in those days, barter system is where somebody who has a gold comes to the market to look for somebody who has a salt to sell to him. Maybe he has a gold but he doesn't have a salt, so he comes to the market and he carries his gold around and he's looking for somebody who has a salt, and the person who has a salt is looking for somebody who has a gold. So by chance they will meet. But sometimes in the barter, you come to the market, you carry your goat and you move around, and you don't see anybody who has a salt that actually wants a goat. Maybe you have somebody who has a salt, but he's looking for a ram, or he's looking for a chicken, or he's looking for a fish. Yes, he's looking for something to use to cook soup, but not a goat. And that was the origin of money. So money came into place to stop one of the problems of barter, which was matching, being able to find people who have the same need to match them. So with money, you don't need to trade goods for goods. You only come with your money, okay, as value, and then you buy what you want to buy. But in decentralized finance, that barter system is still there, because you have somebody who has maybe so and so amount of Ethereum coins and he wants to sell to another person who wants to buy. All you just do is to log onto the platform onto the Ethereum platform, and you put you place your transaction, and then the owners of platform mines the transaction, and then it is sold to another person, and immediately the value moves from your position to the next person position immediately. And if there is any failure in the transaction, you also see it, because the blockchain is formatted in such a way that if, for example, the transaction fails, it reverts to its original position without any of the parties losing value. And you don't pay anything for it, apart from a little token that is paid to the owners of the DeFi application to keep the application running. You don't pay any brokerage, you don't pay any interest, you don't pay any fee. It's very cheap, it's faster, it's transparent, it's also secure. So I will stop here. I've explained to you what centralized finance is. I've explained to you what are the drawbacks are. I've explained to you what decentralized finance is. I've also explained to you briefly what the advantages of decentralized finance is over the traditional financial system. I also want to tell you that as we move along, you also see that a lot of governments, a lot of financial institutions are also not very, very enthusiastic about DeFi. Why? Because it will definitely eat into their income. It will eat into their various income windows. And this, I would like call it, new technology. It's not new, because in the Americas and in the Europe, it's already in operation. A lot of financial institutions are already thinking in that direction. A lot of financial institutions are already building DeFi applications to replace the traditional CeFi, system of doing business, because they know that is where the whole thing is going to. Already it's happening, and that is why I'm very, very excited about this innovation. I'm very, very excited about this project. I'm very, very, really eager to push it, to make people understand, because whether we like it or not, it is DeFi is here with us. There is no going back. Yes, in Nigeria it's not well known. People are not very much aware of that, and that is the essence of running this series, so that people will become aware and probably begin to research more, into DeFi. My aim here is to raise the awareness about DeFi, to bring to fore what is happening in the financial space in terms of technology, and to also tell you that this is here with us, and it's just a matter of time before it really overtakes and push away the traditional centralized finance. So if you are a commercial bank, if you are an investment banker, if you are a stockbroker, I would advise you listen in to this channel and be able to understand where this whole thing is going to. That will be what I will have for this session. By next video, I will now go deeper into the blockchain infrastructure. I will now go deeper into explaining what blockchain really means. I will explain how it operates. I will also explain how you can use blockchain, to build financial application that would be able to make centralized finance, not unattractive. So I will say to you again, thank you for listening. Please subscribe to my YouTube channel, so that when I deliver new videos, you'll be able to see them. Also send me your comments, your criticisms, so that we can together build this channel and make it better. If you enjoyed this video, why don't you send me your comment and let me know what you enjoyed. If there's anything you want me to improve on this video, please feel free to drop your comments, so that we can look at them. Thank you very much, and see you in my next edition. Bye.